The global economy is holding up better than many expected, but four of the world's most powerful economic institutions are warning that the risks are far from over. The International Monetary Fund, the World Bank, the World Trade Organization, and the International Energy Agency have each released assessments in recent weeks. Their conclusions land in roughly the same place. Growth has proven more resilient than feared, even as conflict in the Middle East continues. But significant downside risks remain, and they are not going away. What makes this convergence meaningful is that these four institutions watch very different parts of the global picture. The IMF and World Bank track growth and financial stability across nearly every country on Earth. The WTO follows trade flows. The IEA monitors energy markets, which are directly exposed to conflict in one of the world's most oil-rich regions. When all four point in the same direction, it is worth paying attention, in both directions. Geopolitical conflict in the Middle East tends to threaten the global economy through two main channels. The first is energy prices. If oil and gas costs rise sharply and stay there, inflation picks back up and household budgets tighten around the world. The second is trade disruption. Conflict near key shipping routes raises the cost of moving goods, and those costs eventually show up in the price of everyday products. So far, neither channel has derailed growth to the degree that was feared. That is genuinely encouraging. But resilience is not the same as safety. Global growth remains uneven. Many lower-income economies are under pressure from higher borrowing costs and weaker demand for their exports. Trade policy uncertainty, tariff disputes, supply chain fragmentation adds another layer of stress on top of the geopolitical backdrop. The institutions appear to view these as ongoing concerns, not problems that have been resolved. For markets and policymakers, the central question is whether current conditions hold. A significant escalation of conflict, a sudden spike in energy prices, or a broader disruption to shipping could shift the outlook quickly. Central banks in major economies have spent the past 2 years trying to balance cooling inflation against supporting growth. If energy costs re-accelerate, that balance gets harder to strike. The picture these institutions are painting is not alarming, but it is not comfortable either. The global economy has weathered a difficult stretch better than expected. The question is how long that holds, and what it would take to tip the balance. The practical takeaway: energy prices remain the most direct transmission mechanism between Middle East conflict and your portfolio or business costs. Watching oil markets is not just for commodity traders right now. It is a leading indicator for inflation, central bank decisions, and broader market direction. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.